The value of the dollar has gotten weaker. I mean a whole lot weaker. It has dropped almost 11% in the first half of 2025, which is the largest drop we have seen since 1973. That's about 50 years, y'all, and it is something that I don't think enough people have paid attention to, but there are some pros, yes, some pros and some cons in it, and something that investors should absolutely pay attention to. So what are those things and how can you respond? Let's go ahead and break it down. There's something in that stat that is extremely important. So yes, the value of the dollar. When we say that, we mean the value of the US dollar compared to other countries. And when we talk about exchange rates and currencies, I don't think enough people truly understand what that means. So for example, we are talking about the US dollar and the Canadian dollar, right? If it's 1-to-1, I get $1 and $1 Canadian, and those two things are equal, we're talking about parity. However, if I say the US dollar is getting stronger, that means that one US dollar is now worth more than a Canadian dollar. So now one US dollar is now worth 5 Canadian dollars. So I can now go to Canada and buy way more stuff with the exact same amount of US money. That means the US dollar is getting a whole lot stronger. But what happens if things are in reverse? Right, where one Canadian dollar can now buy $5 worth of US stuff, right? That is what is starting to happen, but not necessarily to that exact degree with the example that I just gave you. But that is what has happened. US dollar is getting a whole lot weaker. Now, the interesting thing here is this. From 2010 to 2024, we had what was essentially a bull market where the US dollar got stronger for 14 years. And that was a stat, it came from Morgan Stanley. That's something I just sat here and made up. Came from Morgan Stanley, and that was something I didn't grasp, okay? Because if I'm just scrolling online, I'm looking at YouTube or whatever else is out there, everybody's telling me that the US dollar is getting weaker. Now, when they say that, they say they took us off the gold standard and everything has been crappy ever since, they're talking about inflation. Now, compared to inflation, yeah, the US dollar has been getting weaker, but when we talk about the strong US dollar compared to other currencies, we had a 14-year run where the US dollar was getting a lot stronger. So what does that mean for you as an investor and a consumer? Here are the cons and the pros, and I'm going to kind of flip back and forth between the two. The first one, which I don't think is as serious and you can pick and choose depending on where you are, is this. It's going to make things more expensive if you are traveling. That kind of goes to the US Canadian dollar example. So if I have US dollars and the US dollar is getting weaker, when I go over there, and it's in any other country not named the United States, I'm going to be able to buy less stuff over there, all right? So my one US dollar is only going to be able to buy 75 cents of stuff over there, or whatever it's going to be. That is going to be a problem. I'm not going to be able to afford as many things as I was before, or it's going to cost me more money. Okay, so that is one thing. On the opposite thing, if I am an exporter, and I'm shipping things out there and I'm selling things, this is actually a good thing for me because it makes my things appear to be cheaper to them and they can buy more of my stuff. And this could be a bit more complicated or complex when it comes to the tariff situation. But for example, if I have an international bestseller, now when my book came out, I was just a bestseller here domestically, but if they're trying to buy this book and my US dollars are cheaper for them to buy, then they may decide to buy this versus whatever it is they have as an equivalent over there, which is a good thing for exports. And in fact, during those 14 years, there were several manufacturers that say, look, I actually kind of wish the US dollar was weaker. That's not something you want to truly say because people don't like to hear that. No one wants to be perceived as weak, but it does help people who are exporting, right? Not necessarily importing, but exporting. That is what they want to do. They want a weaker dollar because they want cheaper stuff for other people to buy. The more that they buy, the more that helps you. If you're just staying domestic, it doesn't truly matter to you as much. But then this is where things start to get a bit more concerning for everyone and investors. And here's where the action piece can come in for you. It makes U.S. assets less attractive, okay, especially for foreign investment. So for example, assume that you are outside of the U.S. You have the option to still buy U.S. bonds. If you buy U.S. bonds, you get them in U.S. dollars. But if it's all the stuff I just told you, right? You're getting US bonds, you're getting US dollars, but the US dollar is starting to get weaker. Do you want to have stocks and bonds grow, but realize like, hey, I'm not even able to buy the stuff I need to buy in my own country because it's getting weaker and weaker and it just dropped by 50-year low. Does that make sense for me? The answer is no. I would rather just keep it in my own country and invest in stuff here. That is the major concern because US investors here, which is the majority of this channel, we are more concerned with, hey, we're fine, right? A little bit. The S&P 500 is near an all-time high. Year to date, the S&P 500 is up right around 9%. This is fine, right? It's good enough until you start to look at what's happening outside of the US. The European stock market is up close to 12% on the year, which last I checked, 12 is better than 9. The Hong Kong stock market is up 27%. Let me say that again. The Hong Kong stock market is up 27%, which I think is 3 times higher than where the US stock market is right now. Foreign investment is saying, hey, I don't want to put my money in the US. I want to put it elsewhere. Here's how that compounds even further. If the US decides, if the Fed decides to lower interest rates, which we all heard what the Fed said and what's going on with the Fed right now, they very well may decide to lower interest rates. If they do that, yes, the US stock market may continue to grow and may give us a shot in the arm and grow a bit more. It may help us to lower the deficit and pay off our debt a bit more. That might be something that is helpful, at least in the short term. Except that is going to chase more money away, chase more foreign money away, especially because why? Why would that be the case? If you are an investor, right, if you are a foreign investor, and even if you're a domestic investor, for us, right, our savings accounts are going to go down, right? You're a foreign investor, you're not going to want to buy US bonds because you're getting 6% and it's going down to 5% going down to 4. And so, well, wait a minute. Y'all are lowering interest rates. You might continue to do so. Why would I do that when I can just go here, where my stock market is already higher? My bond market, I'm not changing over people at the Fed. I don't know if you're going to continue lowering rates, so on and so forth. I might as well just keep things here. That is what people are looking at currently. Also, let's not forget the tariff situation as well. If I'm in a place like China compared to Europe, where trade between those two, at least from my perspective and what I know of, there are no tariffs, no extreme tariffs like we are dealing with today. They ain't got no trade war between those two, right? So if I'm looking between those two, hey, they may not have no tariffs. Those two stock markets are up double digits as of today. Why not just keep my money domestically there versus whatever it is the US is doing? That's how their perspective may be and why their markets today, we'll see what happens in the future, today may be better. So as an investor, what should you do? What is it that you should do? Well, several weeks ago, actually several months ago at this point, who was the person that brought up the fact that you may want to diversify your portfolio and consider investing in Europe and a few Asian stocks as well? Might have been me. You might want to go back and review that video and consider investing in other markets outside of the US. That's not to say that you should sell the US, right? Or do the sell America trade, which is what some people are suggesting, which, you know, it's on the table. But I do think having a large portion of your funds right now in the S&P 500 makes sense. But also strongly consider, and people would argue you should have always done this, but consider adding an international component to your portfolio, especially in a place like today, right? In this place like 2025. That is the context in the world we are in. With international trade, with interest rates the way that they are, look outside of the US to see what is on the table and how the market is moving. 27% gains in Hong Kong and 12% gains in Europe is not anything to just be blind to, okay? Especially as things are changing. So keep your eye on those things. And also, in terms of keeping your eye on stuff, you might want to keep your eye on that subscribe button because, again, this is something we brought up months ago. months ago. So you might want to go ahead and do that as well. However, if you want to go directly to that video and see exactly some of the stocks, ETFs that we talked about, or if you want me to do a brand new and fresh list on that, you want to check out this video right here.